This is your third program in the series on the principles of accounting. When a company buys supplies, pays rent, pays for freight, buys stamps, or calculates a payroll, there are check stubs, receipts, tickets, invoices, statements, working time cards, and the like, which are called business paper or immediate records. But the first formal double entry record is usually in a book called the journal. The entry is called journalizing, which is only done after some person in authority approves the transaction. The journal has columns for the date, a description of the transaction, and debit and credit columns for the amount of money. A posting reference or folio column is also provided for later use. A transaction is recorded in the journal after it is determined what accounts will be affected, which contains the first formal double entry record. Right. Typical journal pages have 5 columns. For date, description of the transaction, account reference, and amount of debit and credit. A journal entry may cryptically say purchase of typewriter and note that both equipment assets and accounts payable increased $500. How would this be entered? An account in the ledger is in effect a subject classified file or information storage container for one class of financial information. If it were never necessary to examine or report on a selected class of transactions by itself, one might say that the original entry in the journal is nearly all that is necessary. Management does, in fact, need to know how much cash or equipment or receivables or debts exist, or the different kinds of revenues which have been received, or expenses which have been incurred. The accounts in the ledger provide the latest detailed information, and the net balances of these accounts provide the data for periodic reports. For example, a company might have, among others, asset accounts 101, 102, 103, and 104 for cash, supplies, inventory, and equipment. Liability accounts 201, 202, and 203 for accounts, notes, and salaries payable, and equity accounts 301, 302, 401, 402, 501, and 502 for paid-in capital, accrued profits, revenue from sales of service, and inventory and expenses for salaries, rent, and so on. A full list of such accounts is called the chart of accounts. A small organization would have a small number of accounts, perhaps 10 or 20, and a large company a larger number, if it wished to study its operations in detail. What do you call the list of all the accounts? Right. Accounts may be added or eliminated, but this is not done very often. When a transaction occurs, it is entered in the journal by date, noting the account to be debited on one line, and usually the credited account on the next line. If it is entered into a computer system, of course, you would key in the transaction according to instructions. If some additional brief comment seems required, it is also copied into the journal at this point. Here's the payment to cash of the capital to start the company. The journal continues with 2 or 3 lines devoted to each transaction. In books kept by hand, entries are in longhand. In each double entry, the debits entered equal the credits. Look over each entry carefully. Should the purposes for the transactions and entries be reasonably clear? Yes. Since both parts of a double entry in the journal is made at once for each transaction, the debits should equal the credits, and this can occasionally be checked by adding both columns. The column totals are shown in small numbers called footings below the last amount. As you can see, all transactions are recorded in the journal chronologically. For certain purposes, a chronological record like this is quite useful. But for the analysis of operations and condition, transactions must be grouped or classified into accounts like cash, accounts payable, and so on. The account sheets are bound in a general ledger, or simply the ledger. Sometimes smaller subsidiary ledgers for certain accounts are also kept. When a purchase of equipment is made on credit, the invoice is received and the transaction is recorded in the journal, debiting equipment and crediting accounts payable. Then later, these entries are transferred or recorded onto the account sheets. This process is called posting. After posting, you can look at each account and see, for example, how much equipment is owned or how much money is owed as accounts payable. What is the name for the book of account sheets? Yes. Remember, the transaction normally goes from business papers to the journal to the general ledger of accounts. What is the name of the process for this last step? Yes. Posting provides the summaries of classes of transactions shown on the account sheets in the ledger. The date, amount, and journal page number are copied on the ledger sheet on either the debit or credit side of the account. A purchase of equipment on credit, for example, would be recorded in the ledger in the equipment asset account and on the accounts payable sheet. It's important to remember that debit entries in the journal are posted to the debit side of the corresponding ledger account, and journal credit to ledger credit. At this time, the account number is noted in the journal's reference column. What three entries are made in each account when posting from the journal? Yes. Normally, the year and month are not repeated in the date. When posting, don't forget that in addition to the three entries in each account in the ledger for a transaction, there is one more, a fourth step. What is it? Some accounting steps are relatively routine, requiring care and attention, but not much judgment. But in making the original entry, judgment must be used in deciding whether the transaction was, for example, a debit or credit to cash, and what other account is also affected. In posting, less judgment is required since the date, amount, account name, and effect, debit or credit, is already in the journal. When posting is up to date, every transaction in the journal appears in the ledger, and both journal and ledger are cross-referenced. The account number is in the journal's reference column, and the journal's page number is in the account reference column. At this time, a trial balance may be taken as a check to assure that the total debits and credits in the ledger are equal. Each total is written in small numbers at the bottom of the last entry in each column. What is this called? In double entry bookkeeping, the total debits of all accounts must always equal the total credits, otherwise there is some mistake. In some respects, making neat entries is an exacting, tedious process, and mistakes are inevitable. About 1% of the initial steps contain some kind of error, so the accounting procedure is organized to eliminate errors. The trial balance is a means of checking for errors by determining if total debits after posting is complete equal total credits. In taking a trial balance, which can be done at any time, each account is totaled and footed, the difference between debits and credits found, and the difference written in small numbers on the side with the larger total. In a certain cash account, the total of debits was $10,600, and the total of credits was $3,200. What would you write? The trial balance has a heading with the company name, trial balance, and the date of the last entry, even though the balance was made up later. List the account titles and numbers in order, recording the net balances in the respective debit and credit columns. Add the columns. If the totals are not the same, there is an error somewhere. And even if they are equal, there may be an error, but that is much less likely. Follow the procedure described, and errors can usually be found. You will recall that the two important major financial statements are the income statement and the balance sheet. These statements are important to a business because when read carefully, they clearly reveal the operations and condition of the company. They are sometimes prepared monthly, are often prepared quarterly, and must always be prepared annually. Besides the two important financial statements, an organization may frequently review total sales, certain accrued expenses, and a cash balance. But what are the two major financial statements? Right. At the top, the income statement has the company name, income statement, and the period of time covered by the statement. The total revenue for a personal service firm or sales for other firms is first listed, followed by the operating expenses, then ending with the difference, the profit. If the difference is negative, there's a loss. The income statement uses some of the information which was on the trial balance, since the trial balance has the net balance of every account, including revenues and expenses. But the income statement doesn't present all of the accounts, since the income for a period is not directly related to assets or liabilities at a certain time. There is a report which is. What is it? Yes. At the top, the balance sheet has the business name, the title, balance sheet, and the date of the statement. To be consistent with debit balances on the left and credits on the right, the assets are shown at the left and liabilities and equity on the right. You recall that debits equal credits and assets equal the total of liabilities and equity. Cash, supplies, equipment, inventory, and other assets are listed under the heading Assets at the left, and accounts, salaries, and notes payable and other liabilities are listed under the heading Liabilities at the right. Below total liabilities is the heading Equity, with capital, net retained income, and other equity items under it. Finally, there is the total of liabilities and owner's equity. This should equal what figure? Yes. On a balance sheet, assets are usually shown on the left side, and liabilities and equity are shown on the right. Yes. Remember, there are two principal kinds of books. The journal, a chronological record of original entry, and the ledger, which binds all the account sheets together. Both
Both books may have subsidiaries such as the cash journal and the accounts receivable ledger. In which book does the entry first indicate which accounts are involved in a given transaction?